Hello everyone, it's October 26, 2015. I'm Grant, this is Gary, and Adam Carlini is our third partner, and we are Dynamic Wealth Management. There's some good things happening in the market right now. We're also excited for the World Series coming up this Wednesday. We're excited for our clients that are in New York as well as Kansas City.
Been a great week. In fact, that makes 4 weeks in a row on the positive side. So some good things to talk about. Let's go ahead and get into it. Okay, folks, let's go ahead and jump into things. First of all, let's talk about some upcoming events we have. We have two types of events that we're doing. The first one is Investments for Breakfast is what we call it. And that is 9 a.m. on Tuesdays right in the conference room here in the office. The next one is November 3rd. And then 2 weeks later, again on Tuesday, November 17th. This is much more informal in nature. We serve a little breakfast. We go into more details on economic events and key stock market events as well. And we also do formal seminars, and this would be the place to come if you're really trying to find out what we're all about, how we are a one-stop shop for estate planning, tax preparation, and obviously investment management as well. The first one is October 27th. That is right in our backyard here in Sun City Grand. Then we go out to Sun City Festival on November 18th. Then we're back here in Sun City Grand November 19th. If you'd like to participate in any of those, we'd love to meet you. Very non-pressure as far as how we do things, and we'd love to see you. Go ahead and call this number down below, and we'd love to reserve a seat for you and your spouse. Risk indicator. Again, our key risk indicator, we use a ratio of stocks to cash, which Grant will touch on specifically when he talks about charts. But here's the good news. We are now into the third week of being on the bullish side in the green zone. So Grant will go into more detail as to what that means. But obviously, this is where we're making money. And as long as the market stays bullish, we want our allocations to match that indication. And again here, we're not trying to predict, and we're not trying to say here that the market will stay in a good situation. What we're saying is, for the time being and given current price action, this is what the market is indicating as a prudent allocation as far as a risk to reward situation is concerned. Now, why is that? What is driving the market? Well, let's talk about two key things that happen with the economy that we feel really push the markets upwards. The first one happened on Thursday, where the European Central Bank came out, and the first thing they did was they held low their key interest rates. Not only that, though, they also made commentary to the effect that they would remain open to a whole menu of measures, is what President Mario Draghi said. In response to that, the euro did fall. So basically, they came out and are stating, and this is how the market interpreted it at least, is that they're willing to create more quantitative easing or stimulus programs to move the economy forward. So the markets, again, interpreted that as a good thing. On Friday as well, similar theme. The central bank from China, the People's Bank of China, also came out, and for the sixth time in a row since last November, they cut their key interest rates and also lowered their bank reserve requirements to create more liquidity in their banking system. So again, we're back to the fact that central banks are really driving the markets. Is that good? Is that bad? Quite frankly, we don't get into that discussion. What we attempt to do is to view how the markets see it, and the markets liked it. And to give you more details as to how the markets reacted to that news and other things, I'll go ahead and turn things over to Grant.
All right, let's jump right into the stock market here. So here's the S&P 500, and we know that each one of these candles represents a day in time. So back here in August, we had a number of really bad days in a row, and we saw this W formation begin. Now, when the market came back down and tested here, and then moved up strong at that, it came to this level, and when it broke this level, that's when we went to a green allocation, and we went into the market. So we've been able to participate to the upside and hold it while we went up here. So now we've completed the W. We made the other side of it here, and we're back to really where we fell from. Generally, that is a good sign. We would as far as from a technical standpoint, we'd expect this to continue to move up a little bit. When it hits resistance at all-time highs, we'll watch it carefully there. Here's the major market indices, and you'll notice that all of the indices here that are stock-driven are up. They're up pretty big here. Now, the only one that's down is the index that is driven by bonds. You'll notice it is down, so that's good. That shows us that there is an appetite for risk in the marketplace and that people expect stocks to rally, at least per their purchases. Here is the S&P 500 sectors. So the leading sectors right now, technology is doing well, industrials is doing well, materials and financials. So those are all what you would consider risk on or the aggressive sectors, and they're leading the way. So we like to see that. Healthcare and utilities are down, and they would be considered conservative, so or the more defensive sectors. So it's telling us that people are moving towards risk and that they expect the more risky things to lead on the upside. It's another good sign for us. As far as market allocations go, as Gary pointed out, here's our ratio that tells us stocks to cash, what's doing better. So as it goes up, stocks does better. As it's going down, cash does better. Right now, stocks are definitely doing better. 3 weeks ago was when we pierced this yellow level, and we've been more aggressive since then, so we participated on these strong up moves, which has been great. So we have a cushion here. Hopefully we'll stay above this yellow line and just keep on going. But if we come back down, we do have some cushion before we would go back into the yellow zone and change our allocations. So that translates to these allocations here. So as we have pointed out, we're in a green zone. So that means if you're a growth client, well, you would be 100% in equities at this point. If you're a moderate client, you'd be 80% equities, 20% defensive. If you're a conservative client, well, you'd be only about 60% in the market here and 40% defensive. All right, folks, we want it to be clear that you understand we're not selling anything, we're not making any specific recommendations. You should always consult with a financial professional before you make any investment decisions. Thank you guys for watching our video. We'll put out another video next week. Please email us with any feedback. Thank you.